Hello, everyone, and a very warm welcome to this week's Major Markets Update for Friday, April the 12th, 2024. Yes, some of these indexes, especially the S&P 500, has been quite frustrating. It did not want to break below our third warning level, 5130. But finally, today, we got resolution. Meanwhile, our preferred wave count was for a larger top in the Dow Jones. That one has now been confirmed. And similarly, as we wrote yesterday for the semiconductors and the Russell 2000/IWM, we remain of the point of view that a larger top has been struck. For the semiconductors, it is most likely a third wave of a impulse. For the IWM Russell 2000, it is most likely a much larger B wave, and we're in the starting gates of a much larger C wave. So we start to see some clarity for some indexes. As I said, the Dow Jones, IWM, semiconductors, simply been the S&P 500, and still actually to this day, the technology sector, which is really holding up. But the charts are starting to show serious cracks, and I'm not too pleased about them from a intermediate term perspective to long term perspective. And as you know, over the last week or two, I became kind of honestly a little bit indifferent on if there will be more upside or not, as I viewed the upside for the S&P 500 in the few hundred points and the downside risk thousands to thousands of points. So we are in a very large major topping zone, and the top can be in, all right? It can really be. And we're going to use the Dow Jones to show the two differences. Meanwhile, we have to remain realistic. This is how people think trading goes. Continuous gains all the time. How real trading goes is this way, right? 3 steps forward, 1 step back. This is my actual return over the last month in one of my trading accounts. And as you can see, I've never had more than 2 down days. If I would get more down days, the third day, I would quit trading, because then something is wrong and I need to reassess. Most people give up here, right? As soon as there's a down day, they give up. Lack of a spine or a backbone, and then we start blaming other people. We don't do it. We take responsibility for our own actions. There's no day, there's no hand, there's no Powell or Janet Yellen is controlling the market behind the scenes. Just the mere fact, honestly, that people think that one single interest rate can control this entire complex global economy is utter delusional nonsense. Can you just imagine just one interest rate? We have the Federal Reserve controlling everything with just one interest rate. Are you out of your mind? This is akin to thinking that carbon dioxide controls everything in our climate. Your weather at this moment is controlled by this tiny little 0.004% of the atmosphere, and everything else doesn't matter. And we all know how complex climate and the weather is. We all know how complex the economy is. And then we think the Fed is just with 1.25% increase or decrease in the interest rate going to control the economy and make us buy and make us sell things, all that stuff. Utter nonsense, in my humble opinion. People need to start to check their minds and get a dose of reality. The Fed is not in control. The only thing is control are us market participants. So with millions of market participants, it becomes sometimes a little hard to know exactly what the market is doing. So we can only be 70% reliable, since we're dealing with a dynamic, stochastic, probabilistic environment. All we do is anticipate, monitor, adjust. And the last couple of weeks have been quite frustrating for several of these indexes. But as I mentioned before, there's been quite a lot of distribution going on. The big boys have been distributing, and they can only distribute over many days. If they would sell everything at once, the market tanks because of their volume they have. They have sell orders in place over many days. Okay, trenches are being sold. And that's what's happened. Investors.com showed, I think over the last 2 to 3 weeks, 7 to 8, at least 7 to 8 distributions. Anyway, remember, stop losses are there for a reason. And as you can see, we have sometimes losses. And this is what stop losses do. They'll get you out before things get too worse and the general trend of your account is higher. So let's start then with the Dow Jones, shall we? Here is the tweet that I sent out earlier today about the Dow Jones. So today was confirmed by dropping below 38,750 that a larger top has most likely been struck already March 21st. That was what we're looking for. So this is our chart from April the 1st. And we already placed back then the potential for this wave 5. We didn't know it back then, right? You can't know it at the exact day. That's not how markets work. So we carried this one. Besides that, we can do one more fourth wave, right? Remember that one? One more fourth wave. And that's also the issue we have now with the S&P 500, all right? One more fourth and fifth wave. Well, we keep moving the goalpost on this fourth wave, and at some point you have to give up. So then today, it finally broke below the cutoff levels, okay, that we had put in place, and that was 38,750, I believe it was. In the meantime, of course, it already broke below this expanding ending diagonal uptrend line. And you can see how amazingly tricky they are. And it looks like we are forming a impulse lower. Okay, now I can show you also the possibility that this is a nested 1-2-1-2 setup, for example. So this is one way of interpreting it. Let me show you here. If we go to the Dow Jones chart, see if I can find it for you there. And let's see if I can find it. So this was then this one more fifth wave to go, right? We're in this one more four. And we had these warning levels. And as you can see, today the Dow Jones broke below it. 4 and 2 can overlap, but 4 cannot go below 2. Impossible. So I have no other way than saying top is in place. So this is potential. Okay. Let's see if I have the other one. There we go. And that is that we are already in this C/3 wave. I honestly start to like this one a little better. 1, 2, 3, 4, 5, A, B, and this is C/3. Note, price is now below the Ichimoku cloud. The whole bull run was above the 50-day and Ichimoku cloud. Now we're already below it. That means weakness. Very simple. So I'm going to look here for about 37,250 plus or minus 250. I think this is a better wave count than this one. It's still possible. It kind of gets us to the same idea. But then we get a 4 and a 5 here. But again, this looks bad. This is a strong uptrend. This is where you buy dips. Now we're in a strong downtrend. This is where you sell rips. We had this long negative divergence. Can you see how long it took? This is 1 month, 2 months, 3 months in a row of negative divergence. So that's why divergence is a condition and not a trick. Okay, it takes a long time before it finally gets confirmed. But here we are. So this is what we're going to look for. Now, bigger picture wise, for those that have been with me for a long time, you know we have two options. The first option is this ending diagonal. The Dow Jones is going to go back to about 36,000 before rallying to a little bit north of 40,000. Okay, so 36,000 will be a retest of the 200-day moving average, and then a last black wave 5 to north of 40,000. Okay, that's all we are going to see, and that's lights out. Okay, then we have a massive ending diagonal primary 5 from the 2020 low, which was primary 4. Then we had primary 3 here in 2018, A, B, C for primary 4. And then this massive ending diagonal where 5 is smaller than 3 is smaller than 1, but 3 is not the shortest wave. Meanwhile, we have to content ourselves with this nauseating negative divergence that has been going on since 2018. Kind of reminds me what we're seeing here, right? See this? See this? See this? We see the same negative divergences develop on all the technical indicators. The MACD, the PMO, the money flow, RSI5, So this one, even with another fifth wave higher, which will be on even more negative divergence, tells us this market is most likely running out of steam. As you can see here, this was the negative divergence on the PMO between 2018 and 2020. And what did we get? MACD, similarly. We're not there yet. This is even a grounder time frame. We're not there yet here on a money flow between here and here. And now we're doing this. You can see here, honestly, nobody's buying. Big boys are not buying. Volume for the markets in the sense of money is made by institutional investors. Your $10,000, $100,000, $1 million account is nothing compared to BlackRock's trillions, Vanguard's millions or billions. What we do, most of us here that are listening are individual traders. Some of you I know are institutional investors. It means nothing for total volume, right? No offense, of course, but that's just the way it is. We all know institutions are the important drivers of markets, and we're just fleas on their fur and happily moving along. But you can see strength is weakening, momentum is weakening, money flow is weakening. Long term, again, I'm now starting to become indifferent on if we're going to get this last fifth wave on a major time frame, as much as I became indifferent on if we're going to see one last gray wave 5 to 53.50, yes or no. It seems most likely not. What is then the most bearish alternative? We've completed a irregular B wave, just as we did here in 2020. Okay, please remember this is possible. And you think that 2020 was scary? That was just a prelude. That just was a warm up to what we can then expect for a primary C wave of a cycle A degree higher. These 2 months were a simple walk in the park compared to what could happen now. The ingredients are in place, but I have zero confirmation this is the case. Okay, confirmation will be below 32,000. That's pretty much the bottom line. If we go below 32,000, I think we can revisit the 22 lows, potentially the 2020 lows. So we have this target zone here, but it can go much, much lower if things accelerate. Again, the monthly chart does not look happy, and it will matter. Okay, just as the daily chart didn't look happy, and it did matter. I think we already are down 5% on the daily time frame. So those are the two bigger picture options we're dealing with. A little bit similar for the other indexes, especially the IWM, and I'll share it with that for a moment. Again, I think the A, B, C is the preferred path. Onto the NASDAQ 100. And we're still above this gray uptrend line, okay? But yesterday's close above this orange trend line was a fake breakout. Fake breakouts can happen. We did not go above orange or red, so I still think this black wave 3 stands, especially with the Dow Jones. Now, what can we then say about where are we going to go if we break down below this gray trend line? Simple symmetry adds the width of this triangle to the downside, which targets, as you can see, 70,300. Ultimately, I still think this black wave 4 is going to revisit this congestion zone somewhere here, right? So there, this is our congestion zone, I think, somewhere around there. This is where we're going to bottom for this black wave 4. But we need to see, of course, a breakdown. Now, note, of course, we're now below the 20-day moving average. We're still just above the 50-day simple moving average on this indicator of index, and that's about it. But as you can see here, the negative divergence is, of course, nauseating. If we look on a closing basis, we can count 5 waves lower, 1, 2, 3, 4, 5. ABC higher, so we should now be in another impulse low. This is the NASDAQ versus the NASDAQ 100. This is the NASDAQ 100 weekly time frame, and that we can still see this black wave 4 and the black wave 5. Question mark. Note the negative divergence. All right, this is double negative divergence on the weekly time frame. MACD has not confirmed this rally either. Money flow is still very strong. This is CFP, but as you can see, we're also here starting to diverge. Okay, So as you can see, we're kind of in a similar setup as where we were in the summer of 2023. So I still think we'll see a few more weeks of downside and then upside and then downside again. So this is going to be at 1 degree higher correction than we saw at the end of the October low. And then possibility of one last fifth wave higher. But it's not necessary because I can count the whole rally since 2022 is complete. 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4. 1, sorry, the 2 here is not there. 2, another 1, 2, and then a 3, 4, a 3, 4, and that's it. So this is 1, 2, 1, 2, 3, 4, 3, 4, 5. With this negative divergence, once again, I'm not holding my breath. I'm not holding my breath for this one. I'll believe it when I see it. I can show you clearly we don't have to do it, okay? But it would look nice. Again, it doesn't have to be that way. Semiconductors, this was our preferred wave count. It's been like this for a while. And again, semiconductors also, they topped more than a month ago. The chart starts to look weak. We're below the 20 and the 10-day simple moving average. Let me zoom in a bit. There you go. So you can see it a little bit clearer. All right, below the 10, below the 20, right at the 50. If the 50 goes, we'll trickle lower for this wave C of 3, for this potential wave 4. It's my preferred wave count because on a monthly time frame, we don't have wave 1, wave 2, wave 3, wave 4, and another wave 5 yet to go. That would suggest the Nasdaq would see the same. Once that one completes, a massive, nasty correction will unfold. So far, there's still negative divergence, on the MACD developing here, also here on the RSI 5. So now we have plenty of charts on the S&P 500. This was the ending diagonal with one last fifth wave we were tracking. But it's become that we keep moving the goalpost count to fit the narrative. Okay, I don't like it. Every single time the market tried to rally, even on double positive divergence, it kind of failed. So what do we see instead? We're seeing a series of lower lows and lower highs, which is bearish. So this is now my preferred wave count, that we're in this C/3. We better get a bottom somewhere around here, a 4 and a 5. Uber bearish wave count is a 1, 2, 1, 2, 1, 2 setup, and we're going to crash in 3 of 3 of 3. Okay, that's the very bearish wave count. It is possible, but so far the bulls have not got any traction other than rallies out of oversold. But every rally has been a lower high ever since the all-time high. This is a different market, right? So we got a rally, a dip, a high, a lower high, a high, a lower high, a high, almost the same, lower high. Okay, you see the pattern? It's of course not all the time, but 8 out of 10 times. And now we're seeing a different path develop with, of course, a low, a lower high, a low, lower high, etc. So this doesn't look good for the bulls. Based on the Dow Jones and semiconductors, the IWM, which I will show in a moment, I therefore prefer that we're going to trickle lower. And this is the aggressive wave count. A break below the 50-day moving average opens a fresh kind of worms, and we can rapidly drop to the 200-day moving average. But I think for now, we're going to focus here somewhere in the high 5,000s for bottom. A temporary bottom. And this is, of course, still the potential for this ending diagonal. But as you can see, the market is unable to break above this rounding top line. Right? It held price in check here, 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 here. So this is very important. And it suggests we're accelerating to the downside. But it starts to look less and less likely. It looks more, as I said, like a rounded top, because the whole diagonal feel and look to it is gone. This does not look like a diagonal anymore. Besides, although they're the least reliable for the trading in that sense, because trend lines can always be redrawn, we've lost all uptrend line support. This one goes back to the October low, gone. Right, this one goes back here, etc. All the trend lines have been broken. Besides, we're now firmly below the 20-day moving average for the third day in a row. That hasn't happened since, well, if we go back here, the October low. Right, we had just 1 day below it, 2 days below it, and that's it. So change of character. MACD doesn't look happy. Money flow doesn't look happy. RSI 5 doesn't look happy. We had a bit of positive divergence at Wednesday's low, and we broke below that. So I think more downside should be ahead. Weekly time frame. Again, this looks akin to what we saw here in early 2018. See the setup here in money flow. I've pointed this out now for 3 weeks in a row. Setup in RSI 5, similarly. Setup in money flow, similarly. So this suggests we should head lower, okay, then potential higher, etc. That's fine. That's really looking far out. What we want to see is a similar setup, which suggests that we could see lower prices. And this is the ending diagonal possibility for the S&P 500 as well. Same as the Dow Jones, oscillating negative divergence on the RSI 14. It shows you how long it takes before it finally matters. Negative divergence on the MACD, negative divergence on the money flow. But here, from 19 into 2021, we had positive divergence. So now, of course, after that, the market needs to move higher. And we're now starting to see negative divergence more and more. It's a condition, it's not a trigger. But as I showed you for the Dow Jones daily chart, it will matter at some point. IWM. This was the possibility for one last fifth wave. Well, forget about it. I think we've topped. We've gone below this wave 4 low. That was our cutoff, right? We already lost trend line support. We already lost 20-day, etc. We've gone below every single warning level. So I have to now say that the IWM has most likely topped. Let's see if I can find it. There we go. This B wave. About a 62% retrace of this row. That's it. Looks very overlapping A, B, C, and that's it. And we should now be on our way to about $100 plus or minus 20, something like that. Quite scary, but it is still very possible. I have no real other way to interpret this price action for the IWM since the 2022. This does not look constructive and bullish to me. And this has been our primary preferred wave count. Small caps have been lagging. It's all been focused on AI and mega cap, but economic sensitive stocks, the smaller caps, have not been doing well, and this starts to look worse. How about market breadth? Well, we've been following this negative divergence in the bullish percent index for NASDAQ for a while. And as you can see, again, it takes months before it finally matters. Just like here in 23, it takes months. Just like here in 2021, it took almost a year. Eventually, it will matter, okay? And it starts to matter. 50% is now bullish, so half. That's about it. If we look here, zoom in on the bullish percent index for the S&P 500, we've been tracking this negative divergence as well. And finally, it kicked in. Okay, again, you see how long it can take, months before it matters. And now we've made here a lower low, as you can see there. We've made a lower low. It means that negative divergence has been confirmed. There. New lows on the NYSE is 60, warning. New lows on the NASDAQ is 212, warning. It's been quite high for a very long time, telling us that the underlying market hasn't been the healthiest overall. Okay, we want to see this below 50, just as we saw here. So the NASDAQ has been, again, primarily fed by mega cap. How are we doing on a McLaren oscillator? Firmly negative, and we're starting to get a bit into bottom territory, but we will likely want to see positive divergence develop before we can be certain that we have it. Meanwhile, the summation index remains on a sell. Moreover, we have negative divergence between December 2023 and March, April of 2024. And again, as you can see here, also the S&P 500 marched higher on negative breadth, just like it did here in May. Okay. Now in May of last year and June last year, we did not get the negative divergence in the summation index line between April and July. Now we have negative divergence. This is, in my humble opinion, akin to what we saw here in 2021 on the left-hand side of your screen. We got a pretty decent correction, and one last hip hurrah before we saw a one-year bear market. Now that would fit, of course, with the possibility of a 4 and a 5. Okay, something like that. Wouldn't surprise me if that's the case. Wouldn't surprise me. I'm not holding my breath for it. Just so you know. Again, this wave 4 would then target somewhere around 4,600, something like that. Okay, and then we're going to go to finally that magic level of about 5,400, because I think the market might have unfinished business with it. But again, to be determined, don't count on it till proven otherwise. So that's really all the charts that I wanted to share. Oh, maybe we should go to seasonality because it seems reasonably on track. Let me see if I can find it for you. Where is my seasonality chart? There it is. Let's go to the Dow Jones and average seasonality over the last 127 years. Okay, this is all years combined. And again, it has a peak somewhere around mid-April and then a decline. But the Dow Jones, as we know, already peaked earlier. So let's have a look then at election years. Election years had a top, as we said, April 6th. Well, then let's go to the Dow Jones. And that's pretty reasonable. April 6th should be here. And it looks like we got a top somewhere late March. So this is still reasonably on track. Not too bad. Okay, not too bad. And we should decline all the way into May. So we should be looking forward to about 2 months of downside. All right. That's all I have for today. Take care. Trade safe. Catch you all next week.